Piet Viljoen, Counterpoint Value Fund Manager. Piet, I had a chuckle at one of your tweets last night. Famous US commentator Jim Cramer attempting to call a top in the oil price. You took this as a strong buy signal. I know Cramer is infamous for running his mouth, but I don't think I've been around long enough to comment on his recommendations. I assume from your comment he's wrong more than he is right.
Look, I haven't tracked it, but Jim Cramer isn't in the investment business. He's in the entertainment business. And I don't think one should take your investment recommendations from someone in the entertainment business. And I think that's basically what it boils down to. I don't think whether he's buying or selling oil means anything at all.
Staying on the energy story, another fund manager, Drickus Kombrink, whose funds also had a remarkably strong 2021. You two sing from the same hymn sheet when it comes to your thesis on energy. I've seen the phrase, your ESG is my alpha, flying around. Could you break that down, what that means in layman's terms?
So I think if one takes a step back to understand how cycles work, I think one has to understand the supply of a commodity, how the supply comes to the market. And demand for most commodities is pretty linear and straightforward, and it goes, bottom left to top right at a certain gradient growth rate. It's easily forecastable, but too many people focus on demand. I think one should, to determine how the commodity cycle plays out, you should focus on supply, because it takes a long time to build an oil well or discover and build an oil well. It takes a long time to discover and build a copper mine, a gold mine, a platinum mine. We're talking 5 to 10 to 15 years. And what's happening in most commodity markets right now is that due to ESG considerations, CapEx is being curtailed. These companies are not spending CapEx on exploration. They're not spending CapEx on building out new mines. Therefore, as the global economy demand grows over time, as it will, because the global GDP grows by 2 to 3% per annum, at some point in the future, and I think we're getting dangerously close to that in some commodities, there will not be enough to meet demand. I think we're seeing that in many energy markets, specifically in Europe at the moment, where energy prices have gone through the roof. And I think that could spread out to other commodities going forward, mainly due to ESG considerations. I think the ESG lobby, and it's not to denigrate what they're doing. I think ESG is important, but one of the things that they are very hard on is this whole transition to clean energy. And I think that transition is necessary, and we should be going down that road. But it entails many trade-offs and nuances, which I think a lot of the ESG proponents are not taking into consideration. So I think one has to bear a lot of those things in mind, and that's why when we say your ESG is my alpha, as they constrain the capital to these mining companies and oil businesses, as they stop them from exploring and stop them from developing new sources of their commodity, the price of the commodities will go up. And we've seen that happening in many commodities, specifically oil and energy right now. And that's where the alpha comes from.
Woolies out with a trading update. That was worse than expected, with the share slightly lower today. The crown jewel, the food business, slowed somewhat, and the rest of the portfolio, beauty and fashion, still struggling. I'm a big fan of their convenience foods, like their club sandwiches, but what's your take on Woolies as an investment proposition?
Yeah, so Woolies consists of the good, the bad, and the ugly. I think the good is a food business. I think it's a fantastic business. The bad is their clothing and home business. That's never really done very well. And the ugly is the Australian acquisition, the department store in Australia. If we had true activist investors in South Africa, like Elliott Advisors and others in the US, they would probably be taking a stake in the business and forcing them to break up the business into three parts. Because at the moment, what you have is the food business subsidizing an average clothing and home furnishings business, and subsidizing a very bad Australian department store business. So I think if we had true activist investors, they would be going for a breakup of this business. Of course, management doesn't want that, because the bigger businesses, the higher management remuneration is, and so it's in their interest to keep everything together.
But Piet, would that be possible in terms of the integration between their food business and their clothing business? When you go into a Woolies in any big shopping center, you'll walk through their food department, and then often their country road and their clothing departments are branch off within the bigger stable.
Yeah, they branch off there because they're being subsidized by the food business. So I think you'll find that there are many Woolies food shops, standalone food shops. There's no reason why you can't split them. No. I think that's a sensible thing to do.
And food retailers as a whole in the JSE, do you hold any in the Counterpoint Value Fund?
Yes, Shoprite is a significant holding for us. We think it's a well managed. It's one of the best managed businesses in South Africa. It continues to take market share across the spectrum from the top end to the low end, and also longer term. I think food retailing, due to the negative working capital cycle, is a very good inflation hedge. So I like owning a food retail business, and I like being able to own the best managed food retail business in Shoprite.
Storage REIT came out with a cautionary announcement relating to its UK operations. Just anecdotally, I was in Joburg for the first half of last year and Cape Town for the second half, and in both cities, their facilities are in every second neighborhood. It's also one of the REITs that's managed to survive this listed property meltdown over the last 3 to 5 years. What are the reasons for this?
The reasons for its ability to sustain itself through the meltdown, well, I think it's offering a product that the market wants and needs. So to that extent, it has delivered. Um, is it a good investment at this point? Well, first of all, I think the directors themselves are selling, and the company is selling shares to the market. So the insiders don't think it's a great investment. Um, Also, I think if one just goes back to what I said at the start, if you want to determine the investment outlook for a product, you have to look at the supply, not demand. And the supply of storage spaces is coming on stream rapidly everywhere in the world, UK and South Africa. So I think there's a lot of supply coming to the market, and I think that might influence the investment outcome for this business going forward.
Let's talk tobacco stocks for a moment. I read an interesting article about Treasury coming after vaping products, basically e-cigarettes. Despite turning the wrong side of 30 earlier this week, I still regard myself as somewhat young, and the youth of today are vaping unabated. Is this the future for companies like British American Tobacco and Philip Morris? What is their commentary in their annual reports like with regards to vaping or e-cigarettes?
They definitely think it's the future, because tobacco smoking is definitely the past. I mean, there's no doubt about that. That is going the way of the dinosaurs. Less and less people are smoking globally. Even in emerging markets, less people are smoking. It's becoming more expensive. There will become a point where it's not affordable. So that's a thing of the past. So the future for these businesses is you do one of two things. You either just diminish over time as less and less people smoke, or you create new products, which they've been doing in varying degrees of success with vaping and non-combustibles and other forms of nicotine delivery. So for British American Tobacco, vaping is a significant product, and they're spending a lot of money on developing that product. And from what it looks like, it seems to be fairly successful. It's not like smoking, but it seems to be fairly successful.
CPI came out hotter than expected at 5.9%. The next MPC meeting is happening soon. What do you expect the Reserve Bank to do?
Yeah, look, they're probably going to hike. I think the market consensus that they're going to hike. I think the market consensus that they're going to hike by 2% over the next year or so. I think that's far too much. Our economy is weak. The inflation that we're having is not because of a strong economy. It's not because of high consumer spending. It's not because of any of those sort of things. It's basically because the inflation is high because fuel prices have gone up due to a combination of high oil price and a weak rand. Hiking interest rates is not going to change any one of those two things. So if I were the Reserve Bank, I probably wouldn't even hike rates at this point. I don't think the economy is strong enough to take it.